What's going on, guys? It's GBP baby. Welcome to another video. Today we're going to be looking at 3 examples of an ICT fair value gap. Hopefully you'll find this insightful. So we're going to be looking at ICT fair value gaps, both bullish ones and bearish ones. We'll be looking at three across 3 different markets and different time intervals, ranging from the I think we're going to go from the daily to the monthly, and then we're going to look at an hourly one as well. And when I say bullish and bearish in this context, I'm talking about inversion fair value gaps mainly, and the way that price reacts to them, because they can be seen to act as support and resistance depending on the narrative or the context of the actual market that we're looking at. There are also implied fair value gaps, which aren't exactly visually seen as fair value gaps, but I'm not going to be looking at implied fair value gaps in this video. But if you want to see that, make sure to leave a comment below. So as defined by Michael himself, that's ICT, a fair value gap is an inefficiency, and as recently defined in his 2023 mentorship, he says that there's 2 different types of fair value gaps. There's a BISI, which stands for buy side imbalance, sell side inefficient, and a SIBI, which stands for sell side imbalance and buy side inefficient. So these are the 2 different forms of fair value gaps, and basically he states in his mentorship how the algorithm is designed to deliver price efficiently, hence why these gaps are places where price was inefficiently delivered, such as here or here, and that means that price has to rebalance these areas, which is why we see price return back to them. So we can so then we anticipate price returning back to them. So I'm going to start with Euro USD, and I have a few fair value gaps specifically that I want to look at. I'm going to start with this one here, which was created on the 11th of November. We're on the daily, by the way. And I'm just going to mark that out, and you'll see how price traded into that and then left it after. But we're going to look at the context of how it returned into it and why it may have returned into it. And we'll look at how price traded. See how we closed the gap, but we didn't. Yeah, right. So let's just get straight into it. So you can see that we took out this high here. I'm also going to release a video looking at buy stops and sell stops, which will explain these kind of swing highs. But we took out buy side liquidity, so then we anticipate retracement. And where does it retrace to? It retraces to this fair value gap, and then it fills it in, and then it trades higher. You'll see that there's another gap here, and you'll see that there's a gap here which aren't filled in, and you'll see our price doesn't actually come to this. Why is that? Well, there's different types of fair value gaps, such as a breakaway gap or a measuring gap. Myself, I do need to still do some work on these because I'm not 100% with them. But when we're bullish, we can anticipate some gaps to be left open, such as here and here. If you want to know more about that, let me know, and I'm happy to make a video on it. So what we're going to do is we're going to look at the 50% level, and the 50% level of a fair value gap is called consequent encroachment. I'll say that again. The 50% level of a fair value gap is called consequent encroachment, and you can anticipate price to trade to this, and to when price shows support at consequent encroachment, it likely is going to continue in the direction it's moving. And what I mean by that is that you'll see how price closes at the 50% level, and then what happens, we continue higher. If we finish completely closed in this fair value gap, I'd see this as quite I see potential for us to potentially draw down. I'd see potential for us to draw down into the next fair value gap, depending on how it trades within it. So make sure, guys, when you're looking at your fair value gaps, you mark out the 50% level, see how price reacts to those levels, and yeah, it'll continue to trade higher. Also in this pair, we have a fair value gap over here, and by the way, this is still the first fair value gap we're looking at, but I'm going to show you how price fills in these fair value gaps. So if you look at the buy side and the sell side, we've got this is the buy side of the curve, this is the sell side of the curve. You'll see that there's a fair value gap right here. So I'm going to draw that out now. And I'm going to make that a different color. Make it blue. Like so. And you'll see how on the sell side, where do we trade to? We trade to the 50% level. I'll show you this now. And this kind of research here, what I'm showing you is what you guys need to be doing in your own charts and looking at yourself for you to completely understand, guys. Don't just come to me or skip through these videos. Like, you should definitely be researching this yourself. So this is the 50% level of this fair value gap, right? And you'll see as we're trading lower, so on the sell side of this price, look what it does, it respects the 50% level. We close below it, and what happens? We continue lower, taking out lows, and that's what I'm saying, how price will trade to consequent encroachment off a fair value gap and leave it if it wants to continue in the direction it's going. But when you look here, you can see how when we're bullish, we trade through that 50% level, and we trade back and forth, and then what happens? We leave the range, and that means that this fair value gap is now has been efficiently delivered, as in we've had delivery on the sell side and the buy side now. Whereas when we were over here, so let's say we're looking at price here, we only have delivery on the downside. Then here we've only had half delivery, and we can see we continue to trade lower. Then we have a reversal, and what happens? We trade to the fair value gap, price then retraces from it, dips one more time into this fair value gap, and steps its way up. So it's quite interesting to see how it does this. ICT does actually have an entire video on fair value gaps, by the way, guys, so make sure you go check that out. But yeah, we're gonna go check out another one, and the next pair is actually in oil, and it's on the monthly. So let's go over to my commodities, and I had one marked out on oil. I wanted to show you how well, you could call it a bearish fair value gap, I guess. And then it's an inverted fair value gap technically, and I'll explain that now. And this time what I'm going to do is I'm going to split it into quarters. So you saw how last time I split it in half for consequent encroachment. In ICT's video that he released this year, specifically on fair value gaps, he explains how it can be divided into quarters completely. So let's do that now. Bear with me. Let's do that together now. And remember, guys, go and watch his videos yourself. Like, this is just me showing you examples of the content which he's already teaching. 09, and then we'll have another quarter up here, which is 2.2. I usually like to make my quarters dots, and then my the 50% dashed. That's what I usually do. There we go. And again, you can see how price grades these levels. So what happens? We have delivery on the downside aggressively. Price then comes straight back up, fills in the fair value gap. Look, we close above it and trade back down through it. Now this is what you call this is where it becomes an inversion fair value gap. Why? We have sell side delivery, making it a bearish fair value gap, so we can anticipate a reaction. But look, we close above it, so now it's a bullish fair value gap. Does it show support? After we trade through this fair value gap, does it show support? No. We trade right down, and on this day specific, well, month even, we trade right down, and then we close below it. So now again, what is it? It's a bearish fair value gap, so we can anticipate bearishness. Does it show support for bearishness? Yes. 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 And then what happens? We trade lower. So these are the way you need to be looking at these fair value gaps. Yeah, and that's pretty much what I mean by inversion fair value gap, and this would be a bearish example of that. And finally, we're going to look at the US 500. I have one on the 1 hour. Let me see if I can find it. I know this one's quite far, so I will be right back. So it was actually the US 500 that my example was. I do have some notes, you see, and I read it wrong. So we're going to do the same thing, and you'll see the exact same treatment of the fair value gap, just in a bullish environment this time. Let me just get my notes up real quick. Cool. So what happens? We have delivery on the downside. We take out sell stops. What happens here as well? You need to look at how price trades to it. Here it continues to act as resistance. So this is a perfect example of a bearish fair value gap. Why? Price trades lower, creates a fair value gap. We trade up to it, and price rejects away from it and takes out more sell stops. These swing highs and swing lows, again, guys, I'm gonna have a video. I'm gonna have 3 examples of buy stops and sell stops, so you understand what I mean when I say that. But you'll see how it rejects the fair value gap. So this, we can anticipate when we have a fair value gap like this, we anticipate it acting bearishly, and that's what we get. We don't even trade into it. It leaves the fair value gap open, take out sell stops, and then what happens? We trade through it. And again, let me grade it. When I say grade it, I mean make the 50% level again. Won't take too long. I do like it to be precise though, guys. just drag it all the way through because I want to show you again how price treats these levels. It is really fascinating, and honestly no one can tell me that this isn't algorithmic, because I'm showing you right now 3 different examples on 3 different time frames in 3 different markets where the same thing is happening. Go there, and then we can have that one and there. Okay, cool. So as I was saying, what happens? So we trade back through, and what happens? We close above the 50% level. Remember, the 50% level, if it closed below it, we might still be bearish, but it didn't, did it? It traded right through and continued higher. We touched it, left it, consolidation, and then we come back down, and is price supporting this now bullish fair value gap? Because look, we have bearish delivery, so it acts bearishly, and then we trade through it, so now we anticipate it to act bullishly. Is it showing support of bullishness? Here, yes. Here, yes. Here, yes. Here, yes. Even here. Now this, it does trade and close it, but look, as soon as we hit the bottom, does it show support for bearishness? No. Why? Because we trade right through it again. Show support again, and then again, and again, and voila. So like, guys, this was a perfect example of a bearish fair value gap turned into a bullish fair value gap, turned into a bearish really quickly, and then bullish again. So yeah. Well, that brings us to the end of the video. I hope you learned what fair value. Well, I hope you enjoyed it. I hope you understand now what a fair value gap is, or I hope you can identify them pretty easily. Make sure to leave a comment if you want to know more about implied fair value gaps, because he's only mentioned that once in his teachings, I believe, implied fair value gaps, and they are very interesting. But yeah, leave a comment, like, subscribe, all that good stuff, and I'll catch you in the next one. This has been GBP baby. Peace.